I will be discussing, and this is just a continuation of my lecture about the basic accounting on debit and credit. I have already discussed 3 pages, and this is the fourth page. And overall, this lecture covers up to 8 pages. So this is the fourth page. So just a mere continuation of page 3. You may ask, what name should I use when I debit something? And the name if I will credit something. The accountant of the company will list down the designated name of the accounts. This is called the chart of account that will be used in recording the debit and the credit account. Although for so long a time, there is a standard account name that was already being used, I suppose, worldwide. Though normally, whatever is the name of what you receive is the name that will be used. Example, you receive electricity service, water service, telephone service, rental, security guard services, professional services of, let us say, lawyers, engineers, so on and so forth. Basically, it is what will be the account name of the debit. Short of saying that when you record electricity, so basically you will debit electricity or telephone or rental or security services or professional services. The name of the debit side is quite easy because you can feel and see the subject or the item to be received by the business. The credit is somewhat hard to know because there are credits that is imaginary or non-tangible, so to speak. Let us say accounts payable, loans payable, or long-term loan, or deposits payable, or wages payable, dividends payable, sales, interest income, gain on sale of fixed assets. These are almost imaginary thing or non-tangible thing. Even a debit sometimes has an imaginary account and not physical thing, like account receivable, loans receivable, cash advances to employees. These are non-physical thing. Let me cite an example. The owner puts up or place a cash to the business as his capital. Easily you know that cash was received by the business. Hence, cash will be the one to be debited. The question is the credit account name to be used. But considering that what was put up was cash, the equal and opposite reaction on that cash is capital or owner's capital. That's why the entry would be debit cash being received, and credit capital. The next part is page 5. So let me show you page 5. And another transaction that the business buys an equipment and the payment will be made on 1 year from the date of purchase. The business has already acquired an obligation or a liability to pay the supplier legally. So the accounting entry would be debit that equipment or debit equipment and credit accounts payable. But why accounts payable? Because what you have given away is your promise to pay that purchases of equipment. As I have said before, that promise to pay is an imaginary thing because it has no physical existence. But by the time that payable is paid, a cash will be given away. At that point in time, cash will be credited and accounts payable will be debited to remove it from the credit side, meaning to remove the accounts payable credit, you have to debit accounts payable. Since the company received an equipment, that should be the name of the account to be used. You may ask again, but sometimes nothing was given away by the company. But as I have discussed, a credit name may be an imaginary thing and not a physical thing. Since what was given to the seller of the equipment is an agreement that the company will pay, a liability has been incurred by the business or by the owner. Hence, the name of accounts payable is, or the name of the account used is accounts payable. Another example, an electric bill was received, but again, it will be paid next month or so. The company actually received a service of electric company in the form of electricity. Therefore, the recording would be debit electricity expense or similar to that because you receive electric service, and credit accounts payable. Since electricity was received, debit electricity. If it is water, then debit water. If it is telephone, it can be debited to telephone or communication expense. Of course, these are all depending on the chart account used by that company. If salaries, it is debited to salaries. If insurance, it is debited to insurance, and so on and so forth. So that is the end of page 5, and I will go to page 6. Another example is where the company did not receive anything tangible, but has given away something. But how come the thing that was given away was not credited, but was credited to an intangible name? Like the company sold its merchandise intended for sale to a customer, but the customer will only pay next year. The accounting entry is debit accounts receivable, which is that is a non-tangible thing or just an imaginary thing, accounts receivable. The same is true with the credit, which is credited to sales. Since what was received by the company is only right to receive the payment, it was the consensus of the inventor of accounting to use account receivable instead of rights receivable. But how come the credit is sales? Why not merchandise? Since merchandise was the one parted away from the company. Take note that the amount of sales and the amount of receivable is not the cost of the merchandise given away or that was sold. The amount of sales is with the amount of which has a markup or a profit. How can you credit merchandise where when it was purchased by the company for resale, the cost is below the selling price? However, though, at the end of the month, another entry will be made so that the merchandise that was given away shall be credited at the amount when it was purchased by the business. Like this entry, debit cost of merchandise or cost of sales, then credit merchandise. So finally, the merchandise was credited finally because it was taken away or parted with at the amount when it was purchased. That means at cost. Supposing when a purchase was made by the company is paid in cash, right then and then, the entry is merchandise credit cash. That is the end of page 6. We go now to the page 7 of this lecture. Let me refocus the camera. This is self-explanatory. Merchandise was received and cash was credited because cash has parted with. The same with when there is a sales made to a customer, where the customer pays cash at the point of sale. So, considering at the time the cash was received, it is debited to cash and credited to sales. When you are selling your product or merchandise, the credit account used is sales. You may ask again, but there is no physical that was given away or is parted away from the company while sales account was credited. And why not credit merchandise when it is the one being sold? If we are going to credit merchandise when the sales is made, it is merchandise inventory was given out. Then probably the following is the entry. Debit cash because the company receives cash. Credit inventory because inventory was taken away. Then, of course, that debit cash includes the markup. And when you credit inventory, it should be at cost. So the difference now between the cash received and the cost of inventory is 1,500. So you will have to credit markup. But this is not the system being used. In the above recording, If the above recording will be made on credit, the company will have no idea what was the total sales in a given period because there is no sales account used. That is why again an imaginary name or intangible account name was used, and this is sales account. Another financial transaction would be the payment of purchases of merchandise or payment of expenses, which was previously credited to accounts payable. And later on, it was paid by cash. The accounting debit and credit would be debit accounts payable and credit cash. Let me continue the last page. Again, as I explained earlier, basically the credit indicates that something was given away or is parted with the business. And since cash was withdrawn, it is credit to cash. But why debit accounts payable? Did the company receive accounts payable? At this point, it is not anymore a question of what was received. It is already a question of reducing or eliminating the previous credit made to accounts payable. That is why it is being debited. In accounting, to reduce the amount of credit, it should be debited. Similarly, to reduce a previous debit, let us say accounts receivable, when collection was made on that account receivable, it is credited to account receivable just to reduce the previous debit to accounts receivable. Just like when a sales was made and the buyer is given to the terms of payment to be 100 days, the debit made was account receivable. But when later on he pays what he bought, the entry is debit cash and credit account receivable. It is credited to account receivable because previously it was debited to accounts receivable. But considering that a payment or a collection was made, the account receivable must be reduced by way of crediting account receivable. Take note that the account receivable now is being credited so that the previous debit to account receivable will be reduced or eliminated because a payment was made. I hope that you have learned something about the whole lecture. That will be all on this topic. Thank you so much to everyone.